My name is Marilyn Anthony, and I'm with Pear Tree Canada. I'm coming to you today from a still sleepy, but just waking up beautiful autumn day in Vancouver. Thank you for joining us in the second session with Robert Kleinman this morning. Pear Tree Canada is very pleased to be sponsoring these sessions and helping us all to learn from Bobby's incredible expertise that many of us know from many years of working with him in the philanthropic sector. A little bit about Pear Tree for those of you who may be joining us for the first time or who don't know of us. Our platform of flow through share donations is widely accepted across Canada by leading wealth, tax, and legal advisors, and of course, philanthropists. We've enabled over $2 billion into the Canadian resource sector and provided hundreds of jobs in the North, plus worked with many of your own philanthropists to make sure that transformational gifts happen now in real time. Today with Bobby, we're going to be live, so you're going to be sitting across from him in the living room. We are recording this session and it will be available to you, as will the slides, most likely by Thursday this week. You may hear us desperately looking for a lifeline from our producer, Laura, and there may be an occasional car or dog, but that's part of the beauty of being live and with you. Please, I encourage you to use the Q&A if you have any questions this morning. However, we know that Bobby's going to get more technical today and going forward. So some of those questions might be better answered online, and we certainly encourage you to do so by sending them to Ask Bobby. To note that our advice today about tax and philanthropic formatting, gift formatting, is not necessarily the advice of Pear Tree, but it is of Bobby. And we do encourage you and your donors to seek professional advice from your own advisors. Encourage you also to come to all 4 sessions as they are consecutive, and the most will be gained by attending all 4. Now, those of you who don't know Robert Kleinman, whom we affectionately know as Bobby, he started his philanthropic career as the executive director at the Jewish Community Foundation in Montreal, certainly one of the most donor-centered charities in the country. But Bobby also brings his expertise as a partner in taxation at Ernst & Young. So those 2 careers really have culminated to make Bobby a leading expert in our field. And he now is a plan giving specialist and writes and advises with charities across the country. So no more ado, Bobby will have you join us and look forward to hearing today.
Thank you. Thank you, Marilyn. So first of all, thank you all for coming back. You can't fool all the people all the time. So thank you. We're the second of 4. The first seminar, we focused on understanding the donor so that we can do good planning and try to earmark what the plans are. This one will look at some basic plans, marketable securities, charitable manure trusts, mining flow-throughs, bequests, and deal with that, and insurance. And then next week we'll do a little more talking about corporations, how they make gifts and how you make gifts of their shares, which is a little bit out of our comfort zone for many people. And then the last one, we'll do a case study, bringing all the techniques together in one gigantic family and how we execute. So thank you very much. Thank you for the questions that came in. And some of the comments were nice. I got a lot of comments about my jacket. So I'm wearing it again. This is a real Alvin Siegel, real cool jacket. So thank you for those comments. There were some other questions. I'll just review a couple of them that we couldn't do live. They're all written out, the answers, so you have that. But someone asked, look, if we're there talking to a donor about their needs, what about our needs? You know, won't they think that we're there to get money for our institution? That's good. It's okay. It's a two-way street. You're not trying to hide the fact that you would like donations for your institution. You want to talk about your institution. At the same time, you're educating them about good things. It's okay for them to know you're there to get money for your place. That's good. That's good. You want that in their mind. Another great question was about when do we bring accountants and lawyers, like our own people, into these plans? I answered that, but as we go through the technical stuff, I'm going to try to bring in when you bring in. But a lot of this is you bring in before. You have to set up your contracts and donor acceptance policies ahead of time. That's where you get your legal help. Then later, it's just accepting gifts. It's not that difficult from your point of view. There were a lot of questions around that. At the end, I threw in a taste about Dev, about holding on to public company shares for a while. And boy, was there angst from that. There were so many questions. And I love that, because that's what I want to do. I want to create angst in you. I want you to say, hey, maybe we should change and adapt and go forward, and not just say, oh, we've been doing it for 50 years this way. But questions like, oh, we're not stockbrokers, and oh, do we give a receipt if we hold on to the shares, and when the capital dividend account doesn't work, and this and all that kind of stuff. So let me just tell you, review. CRA, there's no rule that says if you hold on to the shares, it's not a gift, and it's valued at the date of transfer. It's normal. Capital dividend account is normal. It's just normal stuff. I actually received a call from maybe someone who's on the line today from Toronto, who asked, is the CRA require you to have an asset allocation methodology? No. There are charities who hold on to stock as a normal course. There was an article about the MasterCard Foundation about a month ago in the papers, or 2 months ago, talked about their history. Yeah, they were started with MasterCard stock. That's what they own. It's gone up tremendously. You could hold on to stock. There's not an issue. Another discussion with another charity who had 4 people attend the seminar last week, and they were talking to each other and say, yeah, we looked at our policy and it says we have to sell it. And that makes sense, that policy. It really does make sense. But they said, yeah, but it doesn't make sense for that exceptional situation where we do it. And they're looking at changing their policy. So thank you. Okay. What if we're trying to determine what we're doing here is, if you were going in to see somebody and you're going to talk about a program at your institution and how it works and the data and what you try to do, that's intelligence you're using. How you marry that program up to the needs of the donor is emotional intelligence. Okay, how you bring that in, that's the art. The science is being able to do it. What we're doing here with strategic planning is, yes, how to do a charitable remainder trust or a marketable security gift. Intelligence, science. How you marry that into the needs of the donor where you get trust, that's emotional intelligence. And that's why we've started with understanding the donor. So every time now we look through at a technique, let's think of who this technique is best for. Okay, so that it's not just, hey, everybody do this, it's this is good for you and why. As we go forward here, happy Thanksgiving. We celebrated, and I hope the holiday was nice. But I'm going to say, why do we say happy Thanksgiving? Thanksgiving is about giving thanks for your blessings. And so I want to give thanks to Pear Tree for the blessing of allowing me to talk to you. I want Pear Tree should give thanks for their opportunity to do what they're doing. And what an opportunity they have. And you all, you're the allied professionals on this Zoom, and the charity people on the Zoom, give thanks for your opportunity that you have to do good, to make things happen, to repair the world and do good. And not just for the work of charity, but also to help donors do the right thing. That's a blessing. And we should give thanks to that opportunity. And I know, talk to younger people about this. Sometimes it's so hard to get that meeting. We want to create relationship, get that meeting, and they're busy, they're this or that, life is so difficult, and then they're going away on holiday and things like that. And finally you get, I'll give you 20 minutes. And then you're there and it's an hour and a half and you say, I got to get out of here. Why? Because when they meet with us, it's the best part of their day. It's spiritual, gets them out of the crap of life, of the everything so fast in life and everything, and the business difficulties and everything else like that. It's the best part to talk about charity, to talk about doing good. It's a blessing for all. So now let's go to the slides. And what we're going to look at is this first slide. Go forward. There. Okay. So I'm going to go back to, let's not start with the technique. Let's start with understanding the donor. Okay. And this is a basic slide that I've used for 25 years. Is it perfect, accurate? It's not, but it's my slide. Okay. And so when I'm in front of people, and I'm talking about someone else when I'm talking about people, is, oh, I ask people, can you leave a legacy? And would you leave a legacy or whatever? And often the, whatever the answer is, it is. But I go through and you say, legacy could be a will, could be insurance, could be a trust. It doesn't necessarily only have to be a will gift, but a legacy can come in various forms. And then we try to decipher the question for the person. Is tax help needed at death or not? What kind of stupid question is that? Okay. So if you have someone who has assets, so that on the second death of the couple, there's a deemed disposition of your assets, and there's going to be big tax created because of capital gains. I own a holding company, I own marketable securities that have all these gains, and I'm going to have this tax to pay on it. Or my RSPs, my RIFs and everything is there. I'm going to have a lot of tax to pay. That's information. That leads us to saying, we could do a charitable plan, maybe involving insurance or part of an estate plan that tries to mitigate those taxes, right? Isn't that what we do with a cash gift today? We mitigate taxes. We give a receipt. Here's a $20,000 cash. Oh, here's a receipt. You just saved $10,000. Okay. So if we can understand the tax possibilities and we say, oh, we can maybe look at some plans that could be very helpful to you. On the other hand, tax help not needed. When is that? That's often the assets a person has. If it's cash assets without gains, then they may not need tax help at death. Or if, because of the nature of his plans, he's going to give so much to charity in his will, let's say, so that deduction is going to wipe out all taxes, he doesn't really need to think of tax help at death. He's not going to have tax to pay. That's when we look at these life income plans and we say, can we bring the deductions to his lifetime and save tax today? So I'm already trying to look at our people, look at what's there, understand them better, so that when I talk to them, I can bring forward interesting plans and educate them. Let's go to the next slide. So, we have a different way. So I just will want to point this. I generally always, when I'm asked to help with a will inclusion, I always add, I direct my liquidators, trustees, to the extent possible to make this gift with appreciated marketable securities. You don't need to have it in there. You can still do the appreciated marketable securities even if it's not there. In fact, under the new rules with estates, it's all different. We're going to look at that in a second, but I want to have that there. I want to have it always in people's minds, donating marketable securities, a planned gift, okay, because it's better. Let's go to the next slide. So what I'm going to try to do today is, a lot of these things are basic things. I'm not going to review basics. I'm going to say what's new, what's a different approach, okay? And there are new estate tax rules. There are new bequest rules, okay? And consequently, people don't even, you're receiving gifts, you have a planned giving section of your charity that they bequest. People aren't even aware there are new rules. Liquidators aren't aware that there are new rules. Professionals who aren't aware there are new rules. So what are the new estate rules? And we've had them for, I think, at least 3 years now. Okay. So before, if you had a gift in a will, okay, you were deemed by the Income Tax Act to have made the gift in the year of death. That meant that on your final tax return, you were deemed to have made that gift, $100,000 to the hospital, $100,000 on your final tax return. The estate may not have paid out the will gift for years, because by the time you get the estate done and everything, it could take a few years before it's clear to pay out to the beneficiaries. But yet you just filed the tax return and showed it. Okay. That's old rules. They don't apply anymore. In the new rules, when someone passes away, there's a trust created. Okay. And in that trust, everything happens in the trust. And it's the trust that makes the gift. Okay. not the deceased. The trust makes the gift. And what it does, a trust has a year end and it has a tax return. And in that tax return, it can elect for that donation to be carried back to the final tax return and the year before that of the deceased. So there's a procedure now and a timing thing that's a little bit different. And the next point is that for the trust to either use the donation on its own tax return or to carry it back, it has to pay it. Okay, different from before where, okay, we just did it, we're going to take the credits and maybe we'll pay it 2 years from now. You have to pay it. So there's a couple of, so one is the rules are advantageous for charitable planning because sometimes we were in a situation before where we had the donation deduction with the person, but we wanted it in the trust because the trust had the income. And we have the wrong, we weren't matching the deduction with the income. Here, wherever you have income, you could decide, oh, I want the donation to be used in the trust. Oh, no, I want it to be used in the personal tax return or 50-50 or whatever. So at least you can do that. That's a positive point. Just a couple of things. Because you have to pay out the donation, there's nothing wrong with you when you are aware you're a beneficiary of a will and you have a copy of that says, oh, I'm giving to the institution $100,000. There's nothing wrong with, 6 months after calling up the liquidator and saying, oh, I know we're a beneficiary. When will we receive it? You are aware, of course, that to use that credit on the tax return, you've got to pay it. So make sure it's paid. So it's a way of maybe getting money ahead of time from before. The other thing is to know is that because it's the trust making the donation, it doesn't have to be in the will. As long as the trustees have the right to make donations, right? You don't have to have something in the will for you to get a legacy gift now. You can talk to the family 6 months after the death or whatever and say, oh, your father was so much involved with us and he always was talking about leaving a legacy. Perhaps you'd want to memorialize him about doing it type of thing. Because then if they agree and do it, they can use it on the final tax return, even though it's not in the will. So there's some new opportunities in discussions and whatever, as we know the will. Let's go to the next slide. This next slide talks about a problem that we have in our traditional donations and a solution to the problem. And again, it's about knowing our business and knowing when we talk to people about it. So in a very typical Canadian situation, and I'm going to be sexist here, let's assume a man does a will and spouse, a lady type of a wife type of thing. And often the will be done that says, I leave my spouse, my assets, my businesses and everything, the companies and everything like that in trust. Okay. And what does it mean in trust? It means that she can live off the income from that trust for her life. For emergency purposes, she can take capital out. Okay. And that's a typical scenario. By putting it to the spouse trust, there's a deferral of tax. All those gains don't happen. That's why we talk about tax happening at the second death. Okay. So what happens when the wife passes away, the spouse passes away? Well, the trust says what to do. It says, I wish to give $250,000 to the United Way, and the balance to be split 3 ways between the 3 children. Very typical scenario. In the planning that's gone around that said, when the second spouse dies, the trust has income now. That's the time we have income. The second spouse has passed away. And the trust now has a disposition of those assets that are within the trust, low cost basis, and the trust has significant capital gains. Okay, and we'll have tax to pay. Not the final tax return of the deceased, but the trust. Okay. And But we say, oh, we're going to mitigate that tax because we're giving $250,000 to United Way, and we're going to get the tax slip. And wow, good timing. We're timing this perfectly. We're going to have income, and we're going to have our credits against the income. Okay. So that works very well, except it doesn't anymore. The government, and really, I find it stupid, has taken the position that trust, when it's making a donation, is not making a donation. It's making a distribution. It's told, pay $250 to United Way. They say it's a distribution. It's not a donation. I don't know. It sounds like a donation. Well, the definition of donation says that you have to have intent to do it. The trust doesn't have intent because it's told to do it. There's no intent. There's no decision. So they say you're not going to get a donation receipt, and therefore you have your capital gains to pay tax on, but nothing against it. The solution around this, technical, is to write up the trust agreement that says, I give my trustees the discretion to make $250,000 of gifts to Canadian charities. Okay. And about any balance of money in the trust gets divided 3 ways between the kids. Okay. What's that? Well, the discretion says the trustees have to make a decision. There's intent to give. So then it decides. Now, what you would do is you would have the testator, the write up and send a letter to his trustee. Says, when I die and when this thing happens, I have in my will, I'm giving you the discretion to do 250. I want you to give it to United Way. Okay. You have the right. It's your discretion to do what you have legally, but I want to give it to United Way. So that's our system of getting around the rules, is we write up the spouse trust a little differently. And we have this letter to the trustees saying, these are my intentions, guys, you're going to do what you're going to do the right thing. So you might look in your files and see will gifts that have been set up and things with spouse trust, because it's a very normal thing. Go back in your files. I know we've done that. Okay. And we made calls to people and say, by the way, have you, I know you're leaving to your spouse and then it's coming to us. How is it set up? And we've asked the question and we say, oh, you better look at this again, and wills have been changed. Okay. Next, next one. Okay. But actually, we don't have to keep the slide, but I want to add something about legacy gifts. Okay. If there's a will gift, okay, you should have a contract. This is where your lawyer gets involved. Create a template contract that says, this is between Bobby Kleinman and charity. And it says, Bobby Kleinman has agreed to leave the bequest to charity, and this is how it will be governed. And there you create detail about what will go on with that money. It could be free and clear. You can do whatever you want with it, or it's to be used in this program, it's to be used in this, and things like that. Instead of having all that detail in the will, right, you have it in the contract. And the thing about the contract is the will, every time you change it, costs money and bother. And here, the contract, if you have change of use of whatever, you just talk to each other, re-sign it, and make it very easy. What it's doing also is it creates more contact with the donor, that you have a contract of what's going on. And if they want to use it in the this part of your charity, oh, so you know that you're keeping them informed about what's going on. Maybe as you keep informed and you have that relationship, they're going to give it to you before they pass away, or they're going to add to the gift as they get involved with it. So it's another relationship point by having a contract which they deal with you. They don't have to go to the lawyer again to change it. They talk to you about it. You know where the money wants to go. You can report to them every year about what's going on in that department and things like that. Another relationship point. Okay, now we're talking about charter remainder trusts. And charter remainder trusts are a spectacular mechanism, which we don't use in Canada. Okay, and what we do is we transfer property to a trust today. The trust has income beneficiaries and capital beneficiaries. The income beneficiary during lifetime will be the donor and the spouse, perhaps, that says, for a lifetime, we will get income from that trust. The capital beneficiary will be, during the lifetime, nobody. You can't take out capital, just income. But upon death, the charity. And the reality is that you can give a tax receipt today for this, even though the gift effectively is coming in the future. And here's just an example of the tax receipt. It's a present value calculation. What's the capital? Oh, we're transferring 100,000. What's the year's present value? I don't know, but I'll look at the mortality chart. And that's my years. What's my interest rate? Now I use 3%, 2.5%, whatever. And your example, 100,000, a male, mortality is different for female males, age 78, which means there's a 10.2 years of mortality according to the chart. I'm going to use a 2.5% interest rate. That means that $77,519 is the number. That means if they set up a charitable remainder trust on December 28th this year, 2021, and they do it then, I do the calculation of this year, I can give them a receipt, this person, of $77,519 usable in our 2021 return. To do a calculation, there are these helps on the internet. One of them is at www.jcfmontreal.org, where they have professionals and calculators. You just got to put in male, age, and it'll calculate it for you. So that's a tool for you. So we're going to talk more about this, but now we're going to ask you a question. So now's the time for our question. And the question here is, when we talked about charity remainder trust in the beginning, have you ever spoken to a donor about affecting a CRT at your charity? Have you ever gone ahead and talked to someone about this? Okay. And that's the first question. Okay. Now we're going to close the poll on this question. We're going to go to our second question.
Actually, Bobby, you know what? We're getting some great responses on this. So I'm going to let the first question go for a little bit longer, if you don't mind. And then we'll go over to question 2, but we're getting some great responses here.
Okay, so we see right here is that 87% says no. Okay, and 12% has said yes. Okay, so we can go to the next one. It's enough. And now the second, okay, let's look at the second question. So the second question, as you'll see in a second, says, oh, you've talked to people. Have you ever actually implemented one at your charity where you've actually done it? So that's the second question. It should be up in a second. And if not,
yeah, it's running live there right now. Actually, we're seeing 74% have actually said no. So I will actually.
Okay, there it is. Okay, sorry. Now I see it. Okay. So 74. Okay, so it's about the same number of people who've done it and who've not done it. Okay. So let's go back to the slides. And what we're seeing is that, let's say 1 out of 10 charities have actually do this. And that's quite amazing. If I'd asked you how many have done marketable securities, you'd say, 90% have done it or things like that. So here's one, and we can go to the next slide. Here's one where we don't seem to be using it. Okay. And I remember when I started in plan giving in 94, a CAGP, this great man, Frank, who came up from Seattle and showed us how to do it because it's the biggest thing in the United States. And it started to really reintroduce it into Canada. And there were many charities who were doing it, and they've slipped. Because at the end of the day, the reasons for doing it in the United States were very different from in Canada. It's a different system. It's to avoid succession duties. It's the biggest thing in the United States to avoid succession duties. And therefore, the biggest gifts come by way of this. And in Canada, it's really not for that. And it's got limited use, but very important use. Okay. So I'm going to talk about that, but I'm going to say, how to do a child remainder trust very easily. This is practical now. Okay. So we have a system where we're saying we're moving $100,000 into a trust and we have to manage it. We have to invest it. So the easiest way to do this, okay, is the person has a broker, okay, and to move it from their brokerage account, Bobby Kleinman brokerage account, into Bobby Kleinman CRT charity account. The account is the account of United Way. Okay, so just a transfer there, moving $100,000 cash, and the broker will continue to invest the money like he's doing the other funds, earning interest income, dividend income, having capital gains, and all that kind of thing. And so when we do a child remainder trust, we have to do a tax return at the end of the year. We have to accumulate the income. Very easy with a broker. They send us the slips that shows the T3 slip that shows your taxable Canadian dividends and it shows you your interest income, and they show you your dispositions, right? When we get it personally, they show, oh, you had IBM, your cost is $20, we sold it for $100. So it's very easy to be able to get that information, put it on the return, and do the return. And when you do a trust return, you then allocate the income to the beneficiary because that's who's going to get it. But you have the capital gains, you have the interest, you know the amount of money that you're going to send over to the beneficiary. You get the broker and say, send me $12,000 into our account and we'll send it over to the donor, and you're doing the tax information appropriately. So it's actually a very simple way of doing one without upsetting your investments and everything else. The next slide is the key. So why do we do this? And there's a group of people that this is the greatest plan giving mechanism in the history of the world. And there's great opportunity for the charity to get a lot of money from these people. And so I'm going directly and talking about it. Some of you have heard me say this before. Assume people have no children. One of our donor qualities, we had these 82-year-olds who go to Palm Springs every year, have great assets, no children. So let's think about them. They're going to do will, and the final to die is going to give out their money. Who do they give it out to? Now, normally, in the normal consequence of wills, you give it to your children. They don't have children. So they may give to nephews, but the normal urge of giving to children isn't there. So they're often giving a very large portion of their will to charity. Ultimately, it's going to go somewhere. So what happens on their final tax return? Goes into the trust, it elects back to them. So let's say they have a $3 million estate and they're going to have capital gains on the final return, either in the trust or in the personal. Maybe there's a $500,000 of taxable capital gains, and which is going to create $250,000 of $500,000 of capital gains will create $250,000 of taxable capital gains. Maybe they're going to have RIF income of $400,000, and altogether there's $650,000 of income, which we're not going to pay tax on because we're giving $3 million to charity. The receipt is going to knock out that. No tax to pay. Good. More money going to charity then. But all that receipt that we've been given of $3 million, we're losing it. We're going to use 600,000, 700,000, whatever it is. The rest of it's not used. Okay. Would you like to be in a situation where today you give a $20,000 gift to charity, you get a receipt, but you only use $10,000 and you don't use the other 10? You'd say, oh, I'm missing out on dollars. So here you have a situation where many of those people in this situation have receipts that will not be used. So can we use it during lifetime? Can you imagine the benefit to them of saying, yeah, I'm going to give it at death, but I can save tax today. That's a child remainder trust. We take money from their brokerage account, we put it into another brokerage account. They get the income, nothing changes to them, right? They're getting the income, they're living off the income just as they were before. And all that's happening is they're getting a $77,000 receipt instead of getting, when they pass away, $100,000, receipt, as part of their total part, which won't be used. So the $77,000 receipt is like a free gift, saving them $38,000 of tax, wiping out their taxes. Next year, do it again. No installments to be paid. And we sort of work with people very comfortably. It's like every year we should look at your situation, what your income, your accountant should say us in December, how much income we're going to have on the tax return. What is the good receipt we want? And work backwards with the calculations. Okay, we need a receipt of $42,000. So on the calculations, you should transfer $60,000 into your trust. Next year, do it again. Of course, the calculation will be different. You're a year older, the mortality's a little different. The calculation's a little different. And wipe out taxes for years. What an opportunity for people. They love it. Why do it to me? I wipe out my taxes. Okay. But think about it. They're coming, they're talking to you. You're giving them money every year. And often they donate it back. They don't need the money. So all of a sudden you're giving them $12,000, which is taxable and all that. And they're saying, here, I'll donate it back to you. They're in your office. They're talking to you. You're going to probably get a good part of their estate because you're creating the relationship. You're talking about their stuff. They're in your office. You're helping them dramatically. You're going to get a good part of the estate. So there's so much opportunity here. And I have a quote here on the slide. I just found this Eric Renier of CBC in 2017 wrote an article about how many, looked at the data from the, I guess, our polls that we do and showed how many single person households there are and couples without children there are in Canada. And the numbers are actually quite large. So there's loads and loads of people out there who don't live necessarily the fancy lives and aren't necessarily giving huge sums of dollars out, but they live their lives and they have estates, and that could belong to you if you find them, you help them, and you deal with them. It's a very, very big opportunity. I'm going to show you an alternative way of helping them in a second. But once you get into people, and it's not necessarily just without children. So there are people that we've known that have a nice estate and they have one child, and that child, call it a special needs. And they're nervous about them because what they can't give them money outright for them to, because they'll get blown. They parcel out dollars. So what they want to do in their will is create a trust for their child. It's not charitable, which the income or capital or whatever will go to support, will be given to the child that way. You could do that in your charity. You could be the trust. You could be the home of the trust to do that. You're probably if you do that, you're probably going to get most of the rest of the estate. Okay, they don't want to give $3 million to that child. They don't live that way. They want to make sure the person is comfortable for the rest of their lives in their situation, but the rest of the estate could be yours too. So once you get into people's lives, you can help them and get benefit from them. And the next slide is another way of doing it. It's not a charitable trust. It's exactly opposite. I call it a reverse trust. In the United States, they call it a charitable lead trust. It's a little bit different, but they have that and it's widely used. Okay. So oftentimes when we're seeing with people, and I just visited someone a couple of days ago named Victor, okay, and he is giving a fair amount of money to a project, a charitable project now. We've helped them do it. And in his will, he's giving to people, and a very nice part is going to charity. And all of a sudden he said to me, I have this lady friend. He's not listening. He's 97 and he goes down to Florida and he has a lady friend there. I mean, there's nothing, whatever, but it's a friend. And I say, I want to be able to take care of her. So can we set up something? And again, all this money is going to come into charity. Can we set up a trust for her so we can help her, after I go, type of thing? Yeah. But then I said, let's do it a little differently. You're going to say, let's give her $50,000 a year for 20 years of her life. Well, she may not last 20 years. Okay. So we're going to give her $50,000 a year for as long as she lives, to a maximum of 20 years. So you're going to set up a fund with us where it's going to be invested, where the income goes to the charity, to you, for either you accumulate it and build up a fund, which ultimately will be used to support something, or you use it immediately for your activities. And we'll give $50,000 of capital to the person. This is a Be American. Okay. Why is that better? Well, what it means is that instead of the person effectively receiving $50,000 of income a year and paying tax on it, we're reversing it and saying, we'll receive the income, we don't pay tax on it, and give them the capital. It's just a reverse trust. And that person, instead of paying $20,000 of tax on it, will pay zero tax. So their $50,000 is going to be very much better for them. So again, that's a technique which have been actually in the last 3 years, seeing more and more able to find people who are in that situation who says, I want to leave something. Yeah, this would be a good way, because tax-wise for the recipient is going to be a lot better, type of thing. So new idea, reverse trust. But next time we ask the question, have you talked to someone, if we do this a year from now, have you talked to someone about a CRT? Have you affected one? I want to see the numbers reversed. I don't want to see 10% saying yes. I want to see 10% saying no. Okay? Because it should be part of your systems. Now you bring in the lawyer. Let's do the contract. Let's train our accounting staff who's going to do the tax returns. It's not that hard. It's your team has got to do this. It's not you. It's going to do the tax return, but your accounting staff at your charity, they should do it. It's a team approach. Learn to do this together. Learn to do this and come up with your policies. But next year, I want to ask the question, and I want 10% of you to say no, not 10% saying yes. Let's go on. Okay. So, and again, I'm coming back to this. If I said in my mind what I wanted to accomplish in this 4 lectures, besides all the planning and everything, is particularly charitable in your trusts, and particularly gifts of private company shares, which is where all the money is in Canada, type of thing. Private company shares, which we're going to do next time. So this one I'm coming back to and saying, why aren't you doing it? Do it. Okay. Now, life insurance. Life insurance is a great gift. Okay. Traditional way is you set up a policy owned by the charity, and you pay the premiums, which are tax deductible. You got a receipt for that. And it's a great way to make a bigger gift. Okay. So I won't talk more about that now. I want to talk about something new. Let's go to the next slide. As you're talking to people and you're looking for a legacy gifts and things like that, one of the questions you have, and they say, yeah, we'd like to support, is, do you have an old insurance policy that you'd like to donate to us? Have you ever asked that question? Some people will say, oh, you want to set up a policy with it, but maybe they're sitting with a policy. Okay. So what happens here? First of all, generally, insurance is set up. Why? For various reasons. One of it is for estate planning, for paying taxes, and for other things. But insurance is generally purchased at an earlier age because there's an income flow from your employment or whatever. And if you were to pass away, your family needs to replace that. So insurance does it. That's why we have insurance. From a business perspective, when you operate and you go for a line of credit at the bank and everything like that, the banks used to often say, I want you to take out a policy. Your key people in the company I want you to have a policy because we're lending you money and you're a good risk and everything. But if you were to pass away, this company is going to fall apart. And how are you going to repay us? So take out insurance. Okay. And used to be key man insurance, it was called. And people would take out policies, loads of them. And as time passes, you know, I'm 74 years of age now, and I'm not worried about my kids. They're all grown up. They're doing their thing. They're fine. It's not when I was young and I said, if I were to pass away, how will my family pay the bills? We're way past that point there. Number two, I have this policy that I had to take out for business. The business is gone. We kept the policy because whatever. I paid for years and years of premiums on it. And now I'm 74. I have to pay out a $20,000 premium on this policy. I don't want to anymore. I want that money to be used. I want to go to Palm Springs and use the money there. So Canadians, an important percentage of policies that have been paid and paid and paid are given up. They have value. And they're just giving up. People say, I'm enough with the premiums. You give it up. They tell a broker, I'm not paying anymore. Okay. And insurance companies love this. I mean, if you give it up in year one, they don't love that because that's not business for them. But once you've paid premiums for 40 years, okay, at that point, they have an insurance policy where they have all your money already. The new money they're going to get is not so much, but they're going to have to pay out a bigger sum. Please give it up. They count on it. It's actually part of their numbers. They count on people giving up their policies. So what happens if you were to donate an old policy? Okay, so let's say a policy where, call it a term to 100 policy. What term to 100 is, you take it out and you're going to pay premiums that are level, the same number every year until you're 100. After 100, you don't have to pay anymore. Okay. Which is different than just a term policy, which is I'll pay premiums for 5 years and then the premiums get adjusted every 5 years based on market, which means as you get older, the premiums get higher and higher and higher and higher until when you're 74, it's very expensive. Those policies we don't want. They're no value because it's like taking out a new policy every 5 years. But a term to 100, you're sort of, if you're paying $25,000 a year, the first year you paid it when you were 32 years of age, you probably could have bought insurance for $3,000, but you're paying 25. But when you're 70 and you're paying 25, it may have been 60,000 of premiums that you'd have to buy a policy at. So level is like that. You're sort of investing in the policy over time so that at the end, the premiums are affordable and not higher. So there's value. How would you compute value? It's like, if I were looking at it today for the 74-year-old, I'd say, okay, it's $1 million policy. I will get $1 million when I die. What's that, a mortality chart? 11 years or 15 years. What's the interest rate today? 3%. Okay. So the value of the $1 million is $742,000 today. That's what the $1 million is worth today. Is that the value of the policy? No, because for that mortality for the 15 years, I'm going to have to pay premiums of $25,000 a year. So that reduces the value. And I would do a chart of the $25,000 a year, do the present value of all of that and say, that's worth, on a present value basis, $260,000, that's negative. So $740,000 of positive, less the cost of the premiums. That means that the value of the policy is $500,000. Okay. So if they were to gift that policy to you, you would give them, the actuary would actually do the evaluation. And you'd say, they say it's worth $500,000. Here's a donation receipt for $500,000. Okay, well, I know that when they're alive, it's not like tax-free proceeds of insurance when you die. When you give a donation in kind, there's tax ramifications. Sure, marketable securities, no tax. But if you give a donation in kind, there's income. What's the income when you donate a policy? It's in the Income Tax Act. It's the difference between the cash surrender value of the policy and the cost base of the policy. So for most of these policies, there's no income. It's an amazing thing. It's almost an anomaly. Okay. So here they're getting a $500,000 policy, receipt, which they could use on their return this year. They can carry it forward 5 years. On their federal return, they can share it with their spouse and eliminate $250,000 of tax over the next number of years. So that's a great value to them. And you're creating a legacy for you. So let's ask the question. They may be very happy to get this receipt. Certainly, if they don't have children, right? And another way, like a charity remainder trust, is to say, here, you can give the policy. Ultimately, it's going to go to charity anyway. Give the policy and get the receipt today and use the receipt. So it's got advantage. Now, there are two kinds of people who will do this with you. One will say, I will continue to pay the premiums and get a receipt for it. Okay, good, and things like that. And that's great. You're getting a policy. They're going to pay you. There are some who say, I want to give this up. I don't want to pay. And then you have a decision to make. You make calculations of the value. If the actuary says it's worth $650,000, that means it's a gift of $650,000. You're going to get $1 million and there's a cost to you. It's worth it for you to take it on and for you to pay the premiums. And in one of the newsletters that we have, we go into detail about how to test this, but you would do this and you might do the calculations and then test, you know what, I'm going to test this not on mortality, but let's assume they're going to live to 100, which means I'm going to get the money a lot longer and I'm going to pay more premiums. Is it still valuable? And hey, it's still worth $250,000. So even if in the worst case scenario, it's still valuable to us. You might test the math using a 6% return of income rather than 3%, just to say, is there still value? So this is, I'd say, it's been around a long time, but it's a relatively new gift. And again, dealing with your legacy gifts, dealing with your donors, ask the question. Learn how to do this. And we're going to see, when we do our case study, we're going to actually see computations and everything on how to do this, and you'll be able to do it. Okay. Going on now. Okay. Marketable securities. We know, next slide, we know it works. Here's a chart that you could incorporate in your own slides to show the advantage, to show the cost of giving for this gift was $37,500. No problem. You'll have the slides. You've gotten the slides. You can build your own slides doing it. So what are the points about this that I want to add, which is the next slide? We know it works on just about all marketable securities in the world, most stock exchanges. It works on mutual funds. It requires a transfer from our donor's stock market account to your broker's account. There's a form that they have to sign to give to their broker to do this. Do you have that in your briefcase? Do you have it electronically? So if you're meeting with someone and they say they want to do it, then you give them the form, which will show the details of your broker so that they can do it. Just, are you ready? So, and corporate is even better to do this with, but we'll look at that next week. So I want to talk about something a little different, and that's our donor advised funds. Why would I talk to you about donor advised funds? So you might, as a charity, say, hey, when they give us a gift of $50,000 and we're saying, give us $50,000 in marketable securities, either from the company or personal, as they're doing it. And why? Because the cost of giving is 30% instead of 50%. Fantastic. Will you say, hey, when you do this, why don't you give us $60,000 instead of 50? And you say, why would they do it? Well, we're going to put $10,000 away for you. And then you could tell us to make donations to other charities, smaller ones, that you would never do marketable securities with because of the size, and we'll take care of it for you. That way, you're using a 30% cost on some other donations. We're going to help you do that because you're such a great donor to us. I'm not asking you to become a community foundation. We're going to invest the money. Just, you're keeping the money. It could be in a bank account. You can actually earn interest income on the bank account, 1.25%. That's like your fees that you're earning. You're not charging them fees, but it's like that. Will you do that? There are charities. I know a couple of hospitals in Toronto that have started donor advised funds. There's a university out in BC that have done this. getting closer to your donor, of giving them this opportunity to do this when they do marketable securities or mining flow throughs with you. Do a little more. You're not saying give me $1 million and do this, but give me a little more. What are your other donations you want to do in the next little bit? Oh, I want to do $12,000 other donations, small ones. Okay, you're giving us 50, give us $62,000. Set yourself up, keep it simple. What's the advantage here? One is you're helping them. Two, you're the relationship manager. When you want to make a donation to United Way for $5,000, call me. I'll take care of it for you. And of course, the donation will be made in their name. Okay. You're creating continuous relationship by doing this. Okay. You're calling them back and say, oh, you told us to do it. We sent out the money. Oh, thank you. What's happening? Oh, your program. Just want to tell you about your program that you're doing. What's going on? Relationship. These are tools for relationship. Okay, go on. We're going to go to mining flow throughs now. Okay. There's a slide about corporate marketable securities. We're going to do that next one. You know, we talked about it with our widow last week. We talked about it with Dev. It's a great gift. I want to talk about mining flow throughs. Okay. So mining flow throughs is an interesting thing. And I want to give you some background, because we tend to look at this as, oh, here's the sheet, here's the numbers, da 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 da. But your job is not to sell mining flow throughs. You don't work for Pear Tree. You're not there. You're there just to educate the donor on their availability. It's up to their accountant and lawyer to sort of, work with them. Your accountant and lawyer is there to set up all these processes for you. If someone's giving you insurance, right? Remember I said, do that contract with them. What happens if I give a bequest? List it out. Your insurance, your lawyer should set up that contract. I'm doing an insurance policy. Set up the contract, the proceeds of the insurance policy. This is what will happen. Your lawyer should be setting that up ahead of time. Your chairman, your trust, your lawyer should be setting up your contract. Your accountant, in-house accountant, should be learning how to do the trust returns and doing all that. Afterwards, you don't need it. But here for mining flow throughs, you're not selling. Okay, you just got to be aware of what's there. What will happen in a mining flow through when you're getting the gift is there'll be a contract coming into you, which says these are the rules and that you're going to sell them. Yes, your lawyer should look at it once to make sure that it's okay, and they are okay, so that when you sign off on this, your officer of the foundation, your executive director, your whoever, whatever, has the confidence that I can sign off on these and continue doing it. But we're not selling them. These are very unique to each buyer. Okay, the character, and we're going to go into some of the issues of that, so that their personal tax return is very important. What's in there and what else, their accountant should be looking at this for them, not you selling it. You can say, look how it works, and this is our people doing it, and look what happens here, and the cost of giving on here, and this is what this is what to look for. But you're not selling them. But what is mining flow throughs? Mining flow throughs is a technique that's been used in Canada for decades. At a certain point, the Canadian Parliament said, we want to influence mining in Canada. One of the problems is exploration. What's exploration? There are three parts of mining. Exploration is, I think there's gold there. Let's go find out. We're going to explore. If we find gold, what do we do with it? Well, we have to create a factory to get that gold out, otherwise known as a mine. Okay, let's build the mine. That's development. And then finally, when the mine is ready, we extract, and we have costs and we have income, and that's operations. To finance exploration, when we're saying, a bank will say, oh, okay, I'm happy to finance your activities. You're going to find gold. Well, we might find gold. Oh, you mean it's not sure? Well, how are you going to pay us back if you don't find anything? So it's hard to finance it. So the government said, we're going to find a way to help you. First of all, when you're doing exploration as a company, if that's the stage you're in, we're giving you all kinds of deductions and tax credits, but they're useless to you because you're not making any money. So we're going to allow you to pass through those deductions and credits to your investors who are going to buy stock from you. That's going to cheapen the cost of the stock to them, a benefit to buy it. That's going to put money in your hands to be able to do exploration. And we started, when I started in tax, which I think is in 1979, I remember our clients were buying these CMPs and everything, and we're doing stuff in Alberta, and, buying it out of Montreal, right? And as I tell people that the expression Alberta tar sands, I didn't know that expression back then. Somehow they found stuff. Somehow the companies found stuff. They worked hard. They did their thing. They were smart, and they found stuff, and they found potash in Saskatchewan, and they did all these things. This worked, and we continue to have this system. Okay. And one of the other things is that mining is a little controversial. Do we buy cigarette stocks in our portfolio? No, because mining is also controversial. There's ecology factors, look, strip mining and bad things that result from it. So there's a part of this that says, is this a good business to be in, and things like that. But understand what mining is in Canada. It's a big part of our economy. But where is it a big part of the economy? Not in Montreal, Toronto, Calgary, and Vancouver, or Halifax. Okay. It's in the north. Okay. Where in our climate, it's hard to have economy. It's hard to have a research center for drugs up in the north. It's hard. But if we have these possibilities of doing mining, it creates economy there, and it creates jobs. So I found this on the slide, this government release, Department of Finance, that we're talking about in Nunavut, 97.5% of the residents there who work in mining are Indigenous. So there's part of this all that creates opportunity, and it's great for Canada because, we do it. Hydrocarbons are another issue type of thing, and we all know about that, and warming, things like that. But this is really part of us, and it gives opportunity to people. So as a charitable part of working with this, we're taking care of people in a community which do not have that much economic opportunity, and we're helping. Okay. Now, the concept of this is that you buy it as an individual or corporation, you buy it, and you donate many of the shares that you bought from the company, from Treasury, to charity. Those shares are sold. You've held on to some, you get money, and the charity gets money. And it happens immediately. You buy it, you donate it, and you sell it all within the same few moments. When you buy it, you're already signing a document saying you're selling it. So it's not as if you're looking at that company, is it a good investment, bad investment? You're out of it. You know all the facts. You know the numbers. You know what deductions you're going to get. You know what credits you're going to get. You know exactly the numbers. You know you may hold on to some of the shares, sell it. You're going to get a check. You know exactly what the check is. So the numbers are there. You know that. Next slide. You know that, oh, I'm going to buy it for so much. I'm going to get so much dollars back. The charity's going to get, this is my tax savings. Oh, I'm going to be out of pocket here, $3,000. Okay, that's not good. Oh, the charity is going to wind up with, $48,000. And also, it's costing me $3,000 to make a $48,000 donation. Oh, that's good. That's a good percentage. So it very much works. Okay. What are the risk factors involved with this? Is that we could call three risk factors. One is does it work? Around when this started, and I was lucky enough, I was blessed to be introduced to this in its beginnings of the charity one. Okay. And I say blessed is that because we sort of said this is really good for donors, and we educated so many of our donors on doing it. We had so many people come to us as a foundation and say, can we do this for you? You know, we weren't going out there and trying to get business. It was coming to us. And those people have created so much funds with us, not just mining flow-throughs. It was a great way to people to know us and trust us and everything. So we were blessed to have it. Around that time, there were these charity tax shelters that CRA was coming down hard on. They were bad shelters. Our foundation, we sent to everybody, stay away from them. They were called high-low. You'd buy inventory, let's say $1, and donate it for $10. You'd get a receipt for $10. That was the shenanigans. We have legislation against it, but it's certain, a lot of people bought it in Canada and they got assessed. So there's really, when mining flow-throughs were happening, it's like people say, oh, here's another one of these. Look at this. There's a 5% cost of giving. It's too good to be true. So there was a lot of angst about this. But over time, we looked at this, and one of the things we saw was that the promoters got tax rulings from the government. So it wasn't that the government was saying to this, oh, we found out about this and we don't like it. It's like they were aware of it from the beginning. And even more, I remember going to a parliamentary talk on charities. Our association, CAGP, had sent me there, and we were talking about trying to get some special gifting provisions for private company shares in real estate. But they were asking me about mining company shares. And they said, why should we do this? And I said, I don't know why you're doing it. You're promoting mining. If that doesn't work, then you shouldn't do it. But it's about mining in Canada. Is it good or bad? They said it's good. But they said it's too, you know, it's the deals are too good. I said, well, that's up to you. And what they did is they changed the law and they made it less good. So what did that mean by doing that? It meant that they're on top of it. The government's on top of it. They know everything that's happening. They analyze it yearly. Every year in the budget, they have to come through and say, okay, we're going to give this credit. The credit's only lasting a year, so we have to renew it. So as a tax shelter, the government's fully aware of it. The provincial governments are aware of it. They may not add incentives, do add incentives. They're aware of it. So as a shelter, it's pretty clean. Okay. The risks that we have for it are, one, if the company is saying, we're going to do exploration with your money and give you the credits, what if they don't do exploration? Then your credits are useless and the cost of giving just went up. So you want to, you know, that's the risk. Okay. You want to ask the promoter, how do you mitigate that risk? That's the questions that you want your donors to ask, not you, but the donors to ask about doing it. And they do mitigate the risks in various ways to really reduce that risk. And what happens is over time, because this has gone on now for over a decade, is that, you know, the mining companies know what they got to do and everything, and it's getting cleaner and cleaner from this regard about risk. Okay. But it's a good question. The bigger risk really is your tax return. There's so much credits and everything and whatever, is that you've got to have a big amount of tax return to use it. And also in Canada, we have alternative minimum tax, which says you can't just use tax shelters to bring your tax to zero. You always got to pay some tax. So if you buy enough and you say, how come I still owe taxes? Because you have alternative minimum tax. So you've got to have a tax return. Again, this is not for you as charity people to go and it's for their accountant to say, you know what, you could buy so much based on your tax return. And who knows what they may say, oh, I have 500,000 in my return, and which is great to doing it. We saw in our first lecture, the lawyer, John, who had, you know, 700,000 on his return, great to do this, but he may forget that he has a deduction on his return of $400,000 and he doesn't have the income to do this. So it's up to the accountant to do this, to look at it, to work it out. We're there to educate on that possibility, but their returns. But one of the things that people miss about this is that when you get the sheets from Pear Tree and others about they give you the sheet. Now you should be looking at that sheet. You should be reading it and rereading it, because it's not hard, so that you can talk about it. You can say, oh, well, you deduct, this is how it works. You deduct, you're not telling them how it'll work on their tax return, but this is what happens. You deduct exploration expense. This is what happens. But the assumptions on those sheets they give you is at the highest tax bracket. And people do miss this because, for example, when I bought them, and I bought this for all the years, the highest tax bracket today starts at $218,000. Okay. So I may have bought mining flow through, and the deductions that I'm taking are not necessarily at the highest tax bracket. It may not be in Quebec at 53%. It may be at a lower tax bracket at 49%. Okay. So you've got to really look and see. So when you see what your cost of giving is, it may not be the number that's shown there because your tax rate may be lower. I was always very happy to have a 12% cost of giving, even though I wasn't getting, I'm very happy with that. Okay. So you've got to be, just when you communicate to people and you have people, oh, I've got $80,000 of income, I'm going to buy $20,000 of it. You know, you're going to start saving tax at the 40% level and 35% level. The numbers sort of get different. Okay. So my last thing I'm going to talk about mining flows is really the most important thing I'm going to talk about today. Okay. So it's about leveraging. Charities tend to look at it and say, oh, give $50,000. Here's a way of giving $50,000. But we don't look at it as a tool. Again, strategic and planned giving. It's their words, their adverbs or adjectives. I don't know. Planned giving, planning, strategizing. Can we use mining flow throughs as part of a strategy or plan? Not just, oh, here's a way to give money. Okay. So here's my first example, was a true to life example. I was asked to help someone who wanted to give money to a university, and he was going to give $100,000 over 5 years. And how should he give? And so he had a very nice tax return, and we sort of looked at it, and his accountant said, you know what, we could buy mining flow through to give him about a $65,000 donation comfortably. Okay. And then we said, okay, we want to give 100,000. I don't want to give the rest of it personally because already we're using the deductions personally. Let's look at your holding company, which wasn't an immense holding company, but he had marketable securities. And we said, okay, we're going to give $35,000 of marketable securities. Take the advantages of that, which we're going to see next week. And that's our plan. In other words, we built the plan. And we'll hopefully do this for 5 years. You never know what will happen. Will mining flow throughs be around 3 years from now? They may. The government may say, no, we don't want to, promote mining anymore. So it's part of a mechanism to talk to people, to put it together and not just buy it. Okay. Another example, and this is not the example here, but know somebody who's probably, when he did this, he was like 57 or 56 years of age. And he was asked to do a legacy gift for a charity where he was giving $200,000 a year, and say, could you create the gift so it'll continue when you're no longer here? Okay. So we did it with an insurance policy. Now we're going to see a plan next week where we put it in the holding company and how it works tremendously. But using mining flow throughs, it was even better because he took out a $4 million policy. I think the premiums were about $80,000 a year for 10 years, 800,000 of premiums. Okay. And he had a big tax return. So we said, the 80,000, you're going to buy mining flow throughs to give an $80,000 donation. Okay. Your cost of giving of that $80,000 donation going to be $2,400 a year. Okay. Do that for 10 years. That means your cost of giving over 10 years will be $24,000 to pay up all the premiums to ultimately get $4 million of an endowment to pay your thing. So for $400 million gift, you're out of pocket $24,000. So again, we can use mining flow throughs as leveraging different gift plans to put together. So that was my final comment about that. And I guess we're going to turn this back to Marilyn now for questions that may have arisen.
Thanks, Bobby. We have so many questions. We're just going to try and, we went overtime last week. We're going to try and keep it tight. But we'll start working our way through them, and know that if there are questions that don't get answered today, Bobby will answer them online. Bobby, you can hear me?
I do.
Okay. So, and this is going to be a little bit sporadic because we've got questions on all kinds of topics. You've really inspired some great questions. Is the intent for donations in a trust for Ontario or for all of Canada?
It's federal. It's a federal problem. So Revenue Canada, CRA, has come out with a letter or something, and it was like shocking, okay, to say that in this spouse trust, as this example, there's no intent out of the trust. So it's a federal.
It's a federal thing. Okay. And does this taint the spousal trust? Perhaps it goes back to the description that you had about the 90-year-old friend.
The spouse trust says during the lifetime of the spouse, it can only benefit the spouse. At death, of course, it benefits others. All we're talking about is at death, the second death, where the money goes. It doesn't take the spouse trust because the spouse trust says during lifetime, the only person that could benefit is the spouse.
Okay.
So it
Okay.
doesn't.
And you talked about
Question.
contract.
Wow. Good question.
Good questions. You talked about contracting gifts. Is this only done when you when it's a contingent gift?
Well, sorry. So when I talked about the contract, I was talking about a bequest, doing a contract. It's not a contingent gift. It is I'm putting in my will that I'm giving you $500,000, but I'd like us to develop the template that says, I'm making a contract with the charity that says, I am going to be giving you 500,000 my gift. This is what to do with the money. And as a way of communication of doing all this, of not having to have all that detail in a will, and about continuing to have communication with people. So it's not about contingency at all. It's not contingent, but you do realize when someone makes a will gift, to change it, all I got to do is change the will, and you're no longer in there. Okay.
Mm-hmm.
So the more you have written, the more you're communicating with them, often we've seen situations where we have a will gift in our files and the person has died, 20 years after they gave it to us, and we're expecting the money, and we call the liquidator. Oh no, the version of the will we're dealing with doesn't have you in there. So having that contract, keeping the communication, whatever, is very important.
Yeah, absolutely. Why would someone, Bobby, choose to set up a charitable remainder trust versus a donor advised fund?
It's two different things. A donor advised fund saying, I'm giving up my dollars today for charity, to be used for charity today. A charity remainder trust says, I'm giving up my money for charity. In the future, I don't want to use it for charity today. I want to live off that money. Okay. So it's really two different things. Donor advised fund says, here's money. Yeah. Give me a receipt. Okay. And I want to use it for charity. Here it's saying, I don't want to use it for charity today. I want it's for the future. Now, what does happen is that if you have use of this and they're talking to you, and all of a sudden they may want to start doing it, especially if they have lots of assets. And again, as I say, they're going to get income and they don't want it, and they don't want the tax on it. So, okay, let's use it for the program you want. And then all of a sudden next year, when you're working the tax savings, they may say, you know what, don't put it in the trust, just give it for the program. It actually happens because they don't really, they may be at the point in life as time goes on, at first I want the income, and then as time goes on, what do they need it for? So then when they're saying, I want a $50,000 receipt this year, you know what, just put it into the program and use it. Okay, it actually happens. Okay, you convert the charter remainder trust into actually outright gifts because of a relationship, because of time, because of whatever. Okay.
Yeah. Key word today is relationship, isn't it?
Yeah.
Is there a deemed disposition on the transfer of assets to a charitable remainder trust?
Yeah. So there is a good, wow, good question. There are some esoteric plans around that. It's in the handbook material. There's one there. There's another one in the newsletter where let's say, and again, it's very esoteric, and I'm not for the user here, don't, but it's actually in the newsletter where a gift of marketable securities, where I want to get the marketable security exemption, okay, into this, can be used, okay, but it's not real. It's not a charter remainder trust. I can't do it into a trust. It's a normal gift, and I sort of take back an annuity as my recovery. It's explained there. You can do it to get the exemption, but it's in very fine situations. In the newsletter I write about it, type of thing. If you want to get into, you know, the advanced doctor's level course type of thing, it's in the newsletter. But generally, yes, you put property into it, you have a disposition. Okay, there is something called a alter ego trust where you can put money into a trust and get a rollover into it and treat it like a charitable remainder trust. Okay, where you can perhaps get a receipt for it, but the end result of the alter ego trust is when you die, then you have tax to pay on that. I don't like that. Okay. Yeah.
And is there a difference between a charitable remainder trust and a charity annuity? Gerard asked that.
Yeah, charitable annuity is not a trust. It's something where you give, let's say, $100,000 to a charity, and they're going to get an annuity of, let's say, $4,000 a year for life. Okay, and what used to happen is that the charity would go to an insurance company, and they'd say, okay, I want a $4,000 annuity on the life. We have to pay it. It's going to cost $60,000 to do it. You give the insurance company $60,000. Now you're getting an annuity, $4,000 a charity, and then you pass it on to the donor every year. And they gave you 100,000 to 40,000. You keep. Okay. The problem with that is that about 10 years ago or 12 years ago, the government changed the taxation of that. It used to be a good tax way of doing it. They changed it so that it actually made no difference if you bought the annuity through the charity. It's as if you could buy it directly and give the donation of $25,000. It made no difference. So it was really why, and I had people from finance, why are you bothering with charitable annuities anymore, type of thing. So the market for annuities of charitable annuities have really gone down. People aren't doing it as much. Some people are still doing it based on the old tax rules, which whatever. So it's much so. Charitable remainder trust, which is has similarities to it, is really the better approach and gets the charity more money long term. Yeah.
Okay. We've had a few different questions that ask about threshold gift value or gift level. What's the threshold gift value above which you feel the time and the cost of setting up the charitable remainder trust make it all worthwhile?
Oh,
we stumped you, Gary.
No, I 40,000. Dude, like you're, what you're dealing with is a person of age who may have $80,000 of tax or $75,000 of taxable income on his return, and that's the profile. And if you can get them a $35,000 or $40,000 receipt, $35,000 receipt, that's going to do wonders for them. Okay. Now their estate's $3 million. That's what you're trying to get. So you're investing by doing a charter remainder trust and giving that them, connecting them up, doing a program with them. Next year they'll put another 40,000 in, and next year whatever. So what's it worth it? you know?
Mhm.
No. And here's a statistic, okay, and people will know from the charity. Okay, we've been doing it and dealing with people without children for a long time, and they don't always necessarily do charity remainder trust. They may, whatever. Okay, and I did a statistic onto an annual campaign that our endowments do feed into one of them, and in that campaign today, there's about $2.3 million annually that come from people who've passed away without children who worked with us and set up the funds. That's 2.3 million is about 6% of 7% of their campaign. Okay. If you looked at their giving while they were alive to the campaign, it totaled about $60,000 for all of them. That's become $2.3 million. Okay. And we tend to have done it with themes. In legacy, you have to think a little, because people will say, oh, how can I give them much money? But do you want to take care of seniors? Do you want it? So, a United Way theme, for example, would be dealing with people is, do you want this to deal with food help? Do you want this to do with helping seniors? What's more dearer to your heart? Because all of a sudden it's going to be, they give to United Way $150 a year. And now we're talking about $1 million endowment, which is going to pay out, $50,000 a year into the fund. And so to get them emotionally into that is, what do you care about? Do you care about helping seniors? Well, obviously United Way helps seniors, but they also do that. So when you do that, that emotional intelligence part is, how do you get them to agree to wanting to do something which is meaningful to them, and find this stuff within your charity that's there. And then all of a sudden they're doing it in a different way than just making a donation to United Way, which, I give $150. How much should I go there? No, it's about helping seniors and connecting that up to them.
Yeah, bigger vision. And back to more of the technicalities, with the charitable remainder trust, are the capital gains treated as income for the donor?
In the contract, it says so. It says so, and it is. So that means that, let's say you put in $100,000 into the trust, and in year one, there's $1,250 of dividends that you got and some interest income, and that's your income. Okay. And that's what you'll pass out to them and everything like that. And all of a sudden in year two, the broker sold some stock, and he bought the stock for $20,000 and he sold it for $40,000. Okay. All of a sudden there you have a $20,000 gain, which is part of the income, $20,000. You have $10,000 taxable capital gain. That will go on the slip, and that donor will pay tax on, but you'll give him $20,000 because that's the income. Okay. And the $1,200 of taxable dividend that you get. So you actually give it to him, and then you give him the slip from the trust return, which shows, well, it's $10,000 taxable capital gains and $1,200 of this and things like that. And they'll do it. And that's when they look at this and say, oh God, I don't want this money. Let's put it into the program. Okay. But at first they're very nervous about this. They want the money for their living. They don't give that much charity. So they want the income, and then they get it and they say, what do I do with it? So I pay tax on it, and I do. Yeah.
Might as well give it away. Does the CRT have a restriction on the number of years that it can be a trust?
Wow, that's you know what? Because we have these 21-year rules and stuff. I don't think there's a restriction. I don't think we've seen a restriction. Typically they don't last forever because you're dealing with people. To do the receipt, like if you're 40 years of age and your mortality is 48 years, your receipt's nothing, right? So you're usually dealing with people in their 70s and 80s and things like that. And it just goes on type of thing like that. But there is a 21 years, but you also don't have to do it for life. So you'll have people that will set this up for a child, for example, to be the recipient for 10 years. Again, there's no mortality there. The calculation is 10 years, right? The mortality is 10 years. So you can do different things. A special needs trust for that could be set up for, if it's a charitable trust, which means you're only using the income and not the capital. So often special needs trusts, we're using capital, there's no receipt. But if you're setting up a charitable trust, and one of the problems of charitable trust is if you put it in a will, a charitable trust, they don't give you the receipt. On a technicality, that's a piss off. Okay. That's a new part of the new estate rules that we talked about earlier, that all of a sudden that was their conclusion on the new rules. So, but if you're setting one up while alive, you get a receipt. And yes, 21-year rule. I haven't seen it being applied on this at all, but you know,
yet to be seen. We have questions that'll take us in a different direction, but I'm just going to, we're over time, but I'm going to give you one more on the charitable remainder trust. It's obviously very interesting to everyone. Does the administrator of the trust have to be the charity, or have you seen people create their own trust and have it registered as a charity with CRA, like a charitable foundation?
No, you don't have to register it. They can run their own trust and do all that. However, the trust document says it's going to United Way. So United Way gives a receipt, right? You don't have, the trust is not a charitable engine. It's the gift in the trust. That's the charitable engine. So having it in the trust and it's done, that again, the trust that's managed by the charity is not registered with CRA. It's registered, sorry, it's registered with CRA because you do a trust return. Okay, but it's not registered with the charity division. Okay, it's not a charitable, you know, it's not a charity thing. It's just that the beneficiary of it is there. And according to an IT bulletin of CRA says, if you do this, if a trust is set up, it doesn't say that the charity has to run it. If a trust is set up where this happens, you can give a receipt.
Okay. And does a donor have to create a separate CRT for every charity that they want to donate to?
No, you could have one trust that says it's going to go 40% to 60% to this one and 40% to this one. And then they would give receipts based on 40, you know, their portion. Yeah. Okay.
Well, it's obviously a hot topic, and we literally could go on probably for another hour. Bobby, you're going to address all of these questions in askbobby@peartreecanada.com. Is that right?
And we did this last time, and somehow it's on the site, so for you to see it and get it type of thing. So hopefully look at that site, and you know, the slides are on for this one. You know, look at that site. We're going to want, when we do the fourth seminar, which is a case study, I'm going to want you to look at the slides of the case ahead of time. So that will be on the site, so that when you can read through the case before we do, you know, the seminar. So do look at the website and pull off the things you need. We might have some things on the site yet. Pear Tree doesn't know yet. Some of these computational things that I just may have some examples there that you can take PowerPoint presentations, so you can actually have it and play with the PowerPoint yourself. Great. You know, for facts. So we're going to have that on the site. So yes.
Great, fantastic. Well, I know everyone's looking forward to that and to our next session. And on behalf of Pear Tree Canada and all of our audience today, thank you, Bobby.
Okay, the next session, we're gonna have a lot of fun with corporations. I say it's fun, I'm a nerd. That's where the money is, it's in the companies. Let's go get it.
Wonderful.
See you next week.
Thanks, everybody.